Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. It was a different day in the market today. We had inflation come in at near expectations, but still a really hot and very fast rate. But of course, we don't need a report to tell us that inflation is high. We know it by going to the store. Anything we buy is priced higher. All right, so we're going to talk about inflation today and what the numbers mean. That 7% that came out year over year, what does that mean for inflation and what does that mean for the market? So we're going to get into that. We're going to do a deep dive on Dish Network and the potential for a merger or buyout. Let's talk about that. And also, we're going to talk about Jefferies in a deep dive. Jefferies has been a bellwether company to judge their earnings for how the big banks are going to do it. And remember, big banks start to report their earnings this Friday morning, with Wells Fargo, JP Morgan Chase, and others reporting, like Citigroup. Could this be a warning that maybe growth rates have peaked? So we're going to do a deep dive on Jefferies and talk about the correlation that Jefferies has had with the big banks in their earnings reports that are coming up on Friday morning. So a lot of things to get into, but remember, the most important thing, the whole reason that we're here, is to talk about what's on your mind. If you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. So while you get your questions ready, I'm going to go ahead and get started. But remember, in this market, we have put together our top 10 list for value stocks, for growth stocks, for dividend stocks, and momentum stocks. We have uploaded that. It is out there for you to see. These top 4 categories, we get questions quite frequently. What are the best value stocks to get into as the market shifts to value? What about the best growth stocks as the market shifts over to growth stocks? So we have put this list together. There's actually bonus companies in each list. So it's over 40 high quality stocks ready to choose from that are constantly updated. So you always have the best names available. Click the first link in the description to become a member and get instant access to our top 10 value, growth, dividend, and momentum stocks, and so much more. We've done the research so you don't have to. Okay, in the market today, stocks did trade slightly higher after the initial inflation report was released, but in the afternoon, trade gains were cut as investors lacked any conviction. The Dow Jones was up 40 points on the day, but it was up nearly 200 points earlier in the day. So as the day went on in the afternoon hours, that lead got cut. While the S&P 500, its gains got cut down to 0.3%, and the NASDAQ 0.2%. While the Russell 2000, it actually fell 0.8%. Now, the inflation figures in the U.S. came in line with forecasts, easing concerns that the Fed will need to tighten faster or earlier than they have announced. Also, Treasury yields edged lower, giving the tech sector some relief. The 10-year yield went from 1.74% to 1.71% in the wake of the inflation report, signaling that the inflation rate expectations could be peaking with the Fed planning to tighten policy this year. On the corporate front, stocks linked to economic growth were among the top performers, with chemical company Mosaic rising more than 3%, while software giants such as Microsoft and Alphabet gained more than 1%. Meanwhile, though, Biogen shares sank almost 7% after Medicare said it would only partially cover the payments for its Alzheimer's drug. Traders now turn their attention to earnings season, with Wells Fargo, Citigroup, JP Morgan Chase due to report Friday. 10 of the 11 S&P 500 sectors did close in positive territory, but the light-weighted materials sector, it gained 1%, and it was the only sector that rose at least 1%. The healthcare sector sank 0.3% and was the lone holdout with a modest decline. Now, let's look at this inflation data. The CPI data. Today, the CPI it rose 0.5% month over month in December. Now, the estimate was 0.4% and was up 7% year over year. This represented the sharpest 12-month increase since June of 1982. Core CPI, which includes food and energy, rose 0.6% month over month, and the estimate was 0.5% and was up 5.5% year over year. This was the sharpest 12-month increase since February of 1991. Now, the key takeaway from this inflation report or the CPI data is that while some categories, like the energy index, showed a decrease in December, the continuation of the overall trend resulted in another acceleration of the year over year inflation rate at the headline and core levels. The food index increased 0.5%, led by a 0.9% increase in fruits and vegetables. The energy index fell 0.4%, with the fuel index decreasing 2.4%, while the gasoline index fell 0.5%. The shelter index rose 0.4%, with the owner's equivalent rent of residence, that index also rose 0.4%. The medical care index rose 0.3%. The index for used cars and trucks increased 3.5%, while the index for new vehicles increased 1%. So those are the main takeaways from the CPI data that came out today. Now, you can see we talked about the S&P 500 today. It was up just ever so slightly, and you can see this blue line where it was at. This was recently all-time high territory back here in November and December when it got to those levels and was rejected. Now, on December the 27th is when it broke that line, and we're sitting there now. Can we break above it and rally to a new all-time high level? Or are we going to bounce from this line? Or I should rephrase that, instead of bounce, get rejected at this point and then fall back down to the purple support line here. That's a possibility. If we look, history, 1, 2, 3, 4, 4 out of the past 5 times we have come to this line, we have been rejected. So keep that in mind. We may now be seeing a possible decline in the S&P 500. That's a possibility looking at the chart. Remember, I just said the past 4 out of 5 times we were rejected at this level. All right, let's look at Bitcoin. It's doing okay today. BTC, well, get the cursor in the right place. BTC USD on TradingView, and there is a link in the description for a free account to TradingView. They also have an offer. If you do sign up for a paid account, you can get up to $30 worth of their coin. Okay, Bitcoin is up to $43,905 today. It's up 2.69%, and volume has been almost on par with average today at about 15.5 million. But I'm going to hide volume for a moment so we can get a better look at this setup. Now, Bitcoin, it bounced off of this ascending trend line here, which is really good. And over the past few days, we've been watching it ride this line up higher. But yesterday and today, it took significant moves to the upside. A problem with today, though, is that Bitcoin got as high as 44,342. It was rejected several times today at that $44,000 level. Is that acting as a ceiling right now, as the 50-day moving average and the 200-day moving average are about to cross? and this is called a death cross. Many view it as and myself included, as a lagging indicator, meaning this death cross, the shorter trend, the 50-day moving average, is about to cross below a longer trend, the 200-day moving average, and that in some people's minds, that triggers fear. Oh no, we're going lower. A death cross means we're going to fall. The price is going to drop. But in my view, a death cross is a lagging indicator, meaning we are very close to the bottom if we haven't already hit the bottom. Remember when this death cross occurred back during the summer time frame? I'm going to go and show you right here, right here. On June, what would the exact date be? June 18th, we had a death cross. And let me circle this here to make it a little more obvious. It is right here. It's where the yellow line and the blue line crossed. The short term 50-day moving average crossed below the longer term 200-day moving average. This is called a death cross. And if we look exactly down below on the day that it crossed, Bitcoin was here at about $35,000, but it had already been trading at a low level since, let's go back to May 18th. So from May 18th all the way to the death cross on June 18th, it had already been trading lower for a month. And after the death cross occurred, Bitcoin did go a little bit lower. It went down to this bottom ascending trend line here, which sits right at $30,100. And it turned around, it bounced, and it rallied all the way to a new all-time high of $69,000. So the death cross that is about to occur, and let me put this circle around it to make it a little easier to identify. It's right here. It hasn't happened yet, but it should happen in the next day or two, maybe over the weekend, but it's getting really, really close. And if we look at Bitcoin, Bitcoin has already dropped down significantly. Now, what could happen instead of a death cross occurring, if we go back here and look at mid-September, and I'll circle it here on the chart to make it a little easier to see. Right here, okay, we had what's called a golden cross. And that's when it's the complete opposite of a death cross. It's when a short-term moving average, the 50-day moving average, crosses back above a long-term moving average, the 200-day moving average. And once that occurred, well, Bitcoin, like I said, it had already been rallying. Then it hits the golden cross, which in many people's mind signals that, oh, yes, we're going higher. We're going to rally. Let's go. But again, it's a lagging indicator, because if we look, the bottom here at 30,100, we had already rallied from July the 21st to the golden cross to September 15th. So we've already been in a rally. That's why I call these lagging indicators. They don't mean that we're going lower necessarily or going higher necessarily. It just means that we've been trading sideways for a little bit. Really, that's it, in my view. Now, after the golden cross happened, Bitcoin went down. And that pulled the 50-day moving average, the short-term moving average, down as well. But we didn't get another death cross, but the 50-day moving average did get close, but then we had this big boost, this big rocket takeoff this big rally, which then lifted the 50-day moving average away from the longer term 200-day moving average. So you have those two scenarios. We can either have a death cross, right? Or instead of a death cross, it could just turn and move higher. No cross at all. Okay. So those are the two options that are right in front of us. Now, if we do happen to get a death cross, then it's a lagging indicator. It means we've been going down and sideways for a while now. And if we go all the way back here to the beginning of December when Bitcoin had the really big drop, we moved sideways all the way through December. We had a little rally there over the Christmas holiday, but then it fell back down into this yellow box here. And then we moved sideways, and then we fell down to this bottom trend line support. So if we do get a death cross, it just means we've been moving sideways and a little lower. It's nothing to get shaken up and worried about, in my opinion. Now, of course, the markets can do whatever the markets want to do, and of course, it could go lower. But looking at what's happening right now, Bitcoin is moving higher little by little every day. It has held above this ascending trend line here, which in the past has been the bottom. So, are we at the bottom? There's a good possibility that we are. Could it go lower? Yes, it could. Could it rally and go higher? Yes, it could. All right. So I just wanted to make sure everyone was aware of the death cross, the golden cross, and no cross at all, because there's a lot of chatter now about that death cross coming up. All right. So now you should understand what the death cross is, what a golden cross is. I hope I explained it well enough. All right. Let's look at Ethereum, ETHUSD on TradingView. And if we look, Ethereum has been acting in the same way as Bitcoin, but Ethereum has been outperforming Bitcoin. Ethereum's up 4.3% today, and yesterday it was up over 5%. So it's been moving higher quicker than Bitcoin has. We're at 3380 right now with Ethereum. Now, Ethereum is having a little trouble at its 200-day moving average. That's acting as a bit of resistance to keep the price down. Now, Ethereum is nowhere near any type of cross, like a death cross. The 50-day moving average is all the way up at 39.40, while the 200-day moving average is down at 34.45. And you can see there where Ethereum has been bumping up against that 200-day moving average. But of course, the spread between the 50-day and the 200-day moving averages, they're nowhere near each other. But Ethereum today got as high as 34.20, where the 200-day moving average is at 34.45. So really, really close, about $15 or so. No, a little bit more than that. Maybe $25 might be. That's it, $25. Trying to do my math is not very good. Okay, so a little speed bump there with resistance for the 200-day moving average. Let me put the volume back on here so we can see. For Ethereum, it's right about average. We had about 155,000 versus 166,000 on the volume and the average volume. Okay, there's an overview of the market today. There's a recap and highlights of the CPI data. There's a little talk on cryptocurrency. Let's talk about a few stocks. And before I want to do the deep dives, I want to do a rapid fire of about 5 stocks of interest that things have happened to them recently that could be good, could be bad. First up is Ally Financial. I get asked questions about this bank in particular. Its ticker symbol is ALLY. Ally Financial. It's a smaller bank. I like this bank. I think they're doing a great job. Now, a while ago on the live stream, we had a question about where could this stock be going next? Well, you see my squiggly lines here? I don't want to pat myself on the back because I didn't get it exactly right, but boy oh boy, do those squiggly lines minus the W here match up pretty darn well. I mean, look at the peak that it made today and the peak of the line that I drew here. That is some spectacular prophecy. Okay, enough of the silliness there. But something to point out, Ally Bank, when it was in this falling wedge, and I'm going to circle it here, and I'll make it a different color, but I'm going to circle this right here just to show you. And let me change the color of that. I'll make it red because a lot of people see it as a negative. Okay, this red circle right here, if you can see, I know it's hard on a smaller screen, but you have the blue line, which is the 50-day moving average, and you have the yellow line, which is the 200-day moving average. Well, the short-term 50-day moving average crossed below the longer-term 200-day moving average. That was a death cross. Yeah, the death cross that everyone is freaking out on over on the Bitcoin chart. But here, Ally Financial went through a death cross, and look at the rally that occurred soon thereafter. Isn't that amazing? So when you see a death cross on the chart, you should not get freaked out about it. Typically, what that means is a rally is incoming. And in Ally's predicament, in its scenario here, it was a lagging indicator, meaning that Ally had already fallen from a high of $56.28 all the way down to this low right here on December 1st of $44,096. And then it rallied, it hit the top of the falling wedge, the resistance, and it fell. But that was the last time that it fell. Then it rallied. And to measure this rally, it's not a humongous one, but if we measure from the bottom to where the top was right here, that was a 20% rally. Bitcoin can easily rally 20%. It's not uncommon when you're looking at the volatility of Bitcoin. It is a little more uncommon with a financial stock like this. It's not so volatile as Bitcoin. But I wanted to point this death cross out to you just to show that even though a death cross occurs on the chart, it doesn't mean doom and gloom. Not every time. There is your exception, so don't get me wrong. But Ally Financial, it was just another day. It did fall after that death cross because it was almost to the top of this resistance on the falling wedge pattern here. And then it fell. But then it rallied from December the 20th until today, January 12th. All right. Now, the real reason this was a coincidence that I found a death cross here when I was looking at Ally Financial today. But the real reason why I want to talk about Ally Financial, they were up nearly 3% today. They announced a $2 billion share repurchase authorization, meaning that Ally Financial authorized the company to buy back $2 billion worth of their own shares. I love when companies do that. When you are trying to figure out what is a really good dividend paying stock, don't only look at the dividend yield. If you were to look at Ally Bank, you would see 1.98% is their dividend yield. But you also have to account for share repurchase programs, because that is another form of a yield paying you as a share owner. So when we come up with our top 10 dividend stocks, we account for any share repurchase programs. So when you are looking at our top 10 dividend stocks list, we don't just have the stocks on there that pay a healthy dividend. We have stocks on there that pay a good dividend, but also have share repurchase programs and a couple other proprietary metrics that we look at. So don't get fooled by those that are trying to push you dividend stocks solely based on the dividend yield. There is way more to it. Okay. So there's Ally Financial. Oh, one more thing about Ally Financial. They are also increasing their quarterly cash dividend to 30 cents a share. That's a 5-cent increase per share. So that's really good. All right, next up is Doordash. Thank you very much. Great analysis. Thank you. I appreciate that. Hopefully, I'm providing as much value as possible to everyone watching today and every day. Let's look at Doordash, ticker symbol DASH dash. Now, Doordash was upgraded today to outperform from inline at Evercore ISI. Now, the interesting thing about their upgrade is their price target. Their price target is $256. Now, I put a blue line here at the top of the chart. $256. Their price target is all the way up here at this blue line. Right now, the stock is at $142.49. So, if we measure this potential in the price target, from where the stock currently is to the price target is an 82% rally, an 82% upside in Doordash. And they see Doordash as a pandemic winner that will last beyond the pandemic. I know as personal experience with Doordash, before the pandemic, never used it, not once. During the pandemic, found them, used them, liked their service. When the fast food gets delivered, it's not cold and soggy. It's actually pretty decent. I like their service. It's convenient. They are offering convenience. Now that the pandemic is, I don't know, on its last leg, maybe. We're not in the middle of it anymore, but we're someplace towards the end of it. I now use Doordash more frequently, and I am continuing to use Doordash. And I don't see a particular instance where I'll stop using it altogether. So I think what Evercore is seeing is the same thing that I'm experiencing with Doordash, that many of Doordash's consumers who discovered Doordash during the pandemic realized the convenience of the service will continue to use the service in the future and going forward. So I do find that interesting. It's a pretty money price target, but it does take it back to its 52-week high, which is $157.25. So just 75 cents below their 52-week high. Now, something else that is interesting with Doordash, with all the talk of death crosses, look at the blue line here. the 50-day moving average, and the yellow line, the 200-day moving average. Doordash is right now crossing through a death cross. Now, Doordash has been falling since November 15th. It's a lagging indicator. It means that the fall has most likely already occurred and we're near a bottom. Doordash has found, or seems to have found, some sort of a bottom somewhere around the $120 to $125. So it's already bounced off of that level. Can it keep up the momentum? Well, if we look at volume, volume is higher than average. Today it was 4.7 million. The average is 3.4 million. So it is moving. It does have some momentum. RSI is turned upward. It's at a 41.2. So that's right in there in between. It's not oversold. It's not overbought. Okay, so I found that interesting with Doordash there for a couple reasons. Next, I want to talk about Take Two Interactive. Ticker symbol is TTWO. Now, we did a deep dive on them earlier in the week when the announcement came out that Take Two Interactive was buying Zynga to strengthen their mobile gaming division. Now, Take Two was up 5.1% today. When the news came out, this stock fell and it gapped down pretty darn big. It was up here at around $163 and it fell all the way to $142. And then it bounced back. Yesterday, it was up 3.8%, and then today, 5.1%. So it's coming back. It's filling the gap, as I would call it. Now, there was an upgrade on Take Two Interactive today to outperform from market perform from BMO Capital. Now they also have a price target of $180, which would take Take Two Interactive back to the top of their range that they've been in. If I scrunch this up a bit, you can see that range that they have been in. This bottom that they make down here around $145 and this top that they have around $188. So their price target isn't out of the realm of possibilities. Take Two has been there before. In the video I did on Take Two and their acquisition of Zynga, one of my concerns is the high price they are paying. It's the deal is valued at over $12 billion. The big problem I have is Take Two Interactive is taking on more debt at a time where the macro environment is in a negative light towards growth stocks with rising rates. So that's the only pause that I have when it comes to the deal. I think it's a good deal outside of the fact that they have to take on more debt for this deal to work. All right. So upgrade today. Uh, I think it's a good combination with the two companies. It's just the fact they're taking on more debt in our current macro environment. So that's my only issue with the deal. Otherwise, I think it looks good long term. Now, it's kind of funny. They're coming up to a potential death cross as well on the stock chart. Very interesting. Okay, next, before we do our deep dive on Jeffries and talk about the predictor for the big banks and their earnings on Friday, let's talk about Wells Fargo for just a moment. Ticker symbol is WFC. Wells Fargo got an upgrade today. And if you look here on the chart, they've been rallying really well. And it's been a pretty steep rally at times. This rally back here through 2020 into 2021 was a pretty steep rally. Now, the rally that's happening right now is also pretty steep. So I'm a little concerned that they may be pricing in earnings that they report Friday morning before the market opens. But nevertheless, Wells Fargo was upgraded today to overweight from neutral from or at Piper Sandler. And they have a price target of $64. Now, Wells Fargo is currently at $56.60. It was up about 1% today with the regular session and after hours combined. So, this $64 price target may be the peak for Wells Fargo when they report their earnings. So, just be cautious if you are playing this one. And I must add that out of the big banks, Wells Fargo is one that I like the most, mainly because it had some negative history that brought the stock way, way down. Also brought their valuation down in combination with that. And the risk reward ratio for me looks better with Wells Fargo than, say, a JP Morgan Chase, for example. All right, one more, and then we'll get to Jeffries, and that's Matterport, ticker symbol MTTR. I love this company. It is definitely a growth company, but boy, oh boy, they just cannot get back into the game. They had this really big rally, and if you were with us here early on the channel back here in October, we were talking about this almost daily as this rally occurred. Many of us were in on this rally, but then it hit this peak on December the 1st of $37.60. Now it's down to $15 a share. This sharp fall was pretty big. But for Matterport as a young company that has a mighty big TAM, especially when you include the metaverse, there's a big future for Matterport. But when we look here, I'm going to take the volume and hide it for just a moment. It seems to have found this bottom right here, right? Well, from yesterday and the day before, it went from $14.55 up to $17.30. That was a pretty big move. But today, it was down 8.1%. It fell hard. Now, it seems to be finding some kind of a bottom, but I do find today's fall rather interesting. And the reason why is I believe that the 2 days prior, that rally up to $17.30, I think short-term traders locked in their gains, and sold out. Because yesterday, remember, Matterport named a new managing director for its Americas division. So the big sell-off today, just one day after that big news, it kind of reminds me of a buy the rumor, sell the news for Matterport with its big decline of 8% today. Now, one silver lining is that Matterport right now is oversold. Right now at this point. So my question, and it's at a 27.6. and 30 and below is oversold. So, my question is, will a buy the dip mentality move in on Matterport? I'll leave you with that. All right, let's talk about Jeffries and its crystal ball for the big banks. The ticker symbol is JEF, JEF for Jeffries Financial Group. All right, big fall today, 9.2%. And if we look at the chart here, big moves like that are not typical for Jeffries. Now, the overall pattern here that we see is a very close resemblance to the S&P 500. The only time that it really fell out of correlation with that move was back here in May of 21, where it moved sideways while the S&P 500 was continuing to rise. Now, it did get back into sync when it reached November, and then of course this little pullback here, but this fall today. And what I read in the report, it's very interesting. So, given that Jeffries and their ticker symbol again, JEF, reports its quarterly results just ahead of when the leading financial institutions kick off the earnings season, its report is commonly viewed as a gauge for the health of the group of big bank stocks. Over the past several quarters, the company's blowout results have indeed foreshadowed a stream of very impressive reports from the likes of Goldman Sachs, ticker symbol GS, Morgan Stanley, MS, and JP Morgan Chase, JPM. This morning, though, the script is telling a very different stories as Jeffries barely, I guess is the right word, barely exceeded EPS expectations, while its revenue fell short of estimates. The slide in performance relative to expectations does not necessarily indicate that business conditions have considerably softened overall for Jeffries or the broader industry. In fact, the robust M&A activity, which is mergers and acquisitions, drove Q4 21 advisory revenue higher by 64% to a quarterly record of $588 million. What the significant step down does, what it suggests, is that analyst estimates may have finally caught up with the underlying strength in the advisory and investment banking businesses. Whether this factor leads to more modest beats from others in the space over the next 2 weeks remains to be seen. But it is something for investors to keep in mind. Beyond the more aggressive estimates, there are a few blemishes within Jeffrey's report that are weighing on the stock and other financials, including the combined capital markets and other segment. It experienced a 30% year over year decline in net revenue. To be fair, this segment was lapping a challenging year over year period when a robust burst in equity and fixed income trading fees drove net revenue to a quarterly record of $590 million. However, the 49% plunge in fixed income trading this quarter is notable, illustrating that market conditions in this business are weak. As Jefferies transitions away from its merchant banking roots and builds out its investment banking, that business It has achieved remarkable growth in the investment banking segment while consistently gaining market share. For the fourth consecutive quarter, Jeffries generated more than $1 billion in investment banking revenues. But growth is slowing. Overall, investment banking net revenue of $1.18 billion was flat quarter over quarter, and equity underwriting posted underwhelming year over year growth of 9%. However, it was lapping growth of nearly 150% in the year earlier. Now, the asset management segment that continues to weigh down Jeffrey's results, with net revenue down 52% year over year to $42.8 million. This follows a rough Q3 in which sales were significantly impacted by a difficult environment for multi strategy funds and lower performance by strategies that had strong results during the first half of 21. With Jeffries having rallied about 15% since late December, investors were totally gearing up for another blowout report. Due to raising estimates and sluggish results in a couple of key areas like fixed income trading and asset management, that anticipated blowout, it did not happen. While the investment banking and advisory businesses remain strong, there's concern that peak growth rates have already been reached, creating some angst for the financial sector ahead of earnings season that kicks off this Friday morning. There's my thoughts on Jeffries in their report. They have been a crystal ball for the big banks for several quarters, and with results slowing and growth declining. What does that say for companies like JP Morgan Chase and Citigroup, maybe even Wells Fargo when they report Friday morning? Let me know what you think. Okay, next, I want to talk about this juicy news about Dish Network. Ticker symbol is Dish, DISH. And then after Dish Network, we'll talk about a catalyst or two for tomorrow, potentially, and then we'll wrap up the video. Unless you have questions, we can dive into those. All right, look at this nice climb from Dish Network. Now, I want to point out, since we've been talking about the death cross, right here on the chart, there was a death cross right there. What happened to Dish after the death cross? Well, it did drop for a couple of days, maybe 3 at the most, and then it turned around and started to rally. That's what happened after the death cross. So it's nothing to get all worked up about. Again, it's, in my view, a lagging indicator. Okay, Dish Network. It is beaming up today after the New York Post reported that the company and DirecTV are again discussing a merger. The most recent discussion in late 2020 fell through when the Department of Justice, or DOJ, commented that a merger would need to wait until 5G is rolled out in more rural markets. However, as AT&T, ticker symbol T, closed on its deal to sell 30% of DirecTV, valued at $16.25 billion to private equity firm TPG Capital this past August, the news source is now spurring the negotiations. Additionally, AT&T has expanded its 5G availability since 2020. Although the 5G service offered in more rural areas is noticeably slower than 5G found in urban settings. it is still significant that AT&T has deployed many more 5G towers in additional states, covering all over, I believe it's 250 million people as of September 21, compared to 120 million in April 2020. Also, streaming services have caught fire since the pandemic, aggressively chasing customers away from traditional satellite and cable TV. For example, live TV streaming service Fubo TV. I think that's how it's pronounced. The ticker symbol is FUBO. More than doubled its paid subscriber count year over year in Q3 to nearly 1,944,000. Although this count does pale in comparison to that of Dish Network, which boasts over 8.2 million paid TV subscribers as of Q3, the rapid growth of Fubo TV paints a concerning picture for paying paying viewers going forward. When factoring in users of other live TV streamers like YouTube TV and Hulu, and YouTube TV that's owned by Alphabet, and Hulu is owned by Disney, the subscriber count quickly reaches an estimated 8 million combined, not to mention users of lesser known private companies like Vidgo and Philo. It is worth pointing out, though, that Dish TV also owns live TV streaming service Sling TV, and that DirecTV has its own streaming service labeled DirecTV Stream. However, both services have not reached the same level of success as the competition. For example, Sling TV, it grew its subscriber count by just 4% year over year in Q3 to 2.56 million. AT&T has not broken out its its DirecTV Stream subscriber count. However, before being rebranded to DirecTV Stream in 2021, it was AT&T Now, which had lost about 29% of its subscribers year over year by the end of 2020. Meanwhile, Dish Network's pay TV subscriber base, it fell 6% year over year in Q3 and is now down 38% over the past 5 years. In addition, in Q2 20, the last time AT&T reported DirecTV statistics, DirecTV lost 5% of its customers year over year. Therefore, due to increasing competition and improved 5G coverage, combined with declining subscriber count for Dish Network and DirecTV, the possibility of a merger has never been more likely. However, the Dish TV and DirecTV merger would create a traditional pay TV company boasting over 20 million subscribers, with streaming services that would add around another 3 to 4 million. Against the backdrop of intense competition from cord cutting services, the combined company does not look like the monopoly it may have seemed just 1 year ago. Finally, AT&T, through its addition of 2.6 million fiber customer locations and its rollout of 5G to more areas around the US, has done a decent job of fulfilling one of the main setbacks pointed out by the DOJ during the prior negotiations. Bottom line, Dish Network is increasingly likely to be a takeover candidate. And from that position, from that perspective, it could help fend off the rise of cord cutting streaming services that threaten pay TV's future. So, what do you think about the streaming wars and all of the cord cutting from cable to streaming? Are we getting too many streaming companies out there for us to handle? I mean, we already have a Netflix account, a Disney Plus account, a Hulu, a YouTube TV, and the list goes on. Are there too many? And will these streaming companies start to consolidate? And we finish the circle by going back to a structure similar to cable, but in a streaming era. I don't know. It's an interesting thought, none the least. Okay, Catalyst Watch for tomorrow. Like today, we got the CPI data. Tomorrow, we get a reading on the PPI, which is the Producer Price Index. What is the cost of raw materials? Now, the month over month expectation is 0.4% for December, down from November's 0.8%. So the producer price index, that's one to watch for tomorrow. A specific stock to watch is Taiwan Semiconductor. Ticker symbol is TSM. I would put them on a list for a catalyst watch for tomorrow. Now, they were up 2.3% today, another 10% in after hours. They report earnings with an estimated EPS of $6.21, with revenue of $436 billion. Now, options trading for Taiwan Semi implies a swing in share price of 6.2% after the numbers drop. Taiwan Semi has been range bound for a year now, and it's currently sitting outside the top of that range. There are a number of macro tailwinds that will continue to push demand for Taiwan Semi throughout 2022 across high performance computing, automotive, and Internet of Things. So, I'm expecting big things for Taiwan Semi throughout 2022. The earnings report for tomorrow, I'm a little concerned it may be priced in. Only because, and I do find it shocking, that Taiwan Semi has been in this range for over a year, while companies like Nvidia, AMD have been rising, especially Nvidia, although recently it's pulled back. This range bound from Taiwan Semi, I think, is undeserved. I think this stock should have already rallied. And you can kind of see one if we go from the bottom here of the last earnings, and I should have a vertical there. And this bottom here was $108. And right now we're only up less than 30 bucks to 132. It's a small rally, and I think the company is deserving of a much bigger rally. But we'll have to see how the earnings come out tomorrow. But with this 2.3% jump today, yesterday was a 3.3% jump. If we are looking at a 6.2% swing according to the options market, if we line that up where we are right now, If we go up 6%, I can only go up 5 without adjusting this. 5% would put it, where is that? 138. If we go down 6.2%, that puts us almost back to the top of the range. So, if we're looking at options, 6.2% swing from the top of this range to where we are right now at $132.40, that's about a 6.5% move to the upside outside of this range. Could that be what the options market is thinking? That maybe it goes back down to the range, top of the range. It's a possibility. I think unlikely. I think this company is deserving of more. But it is valued at $608 billion. So it's one to watch tomorrow for its earnings. All right. I'll go ahead and wrap the stream up here. Thank you guys for joining. Remember, if you want to know what our top 10 value stocks, top 10 growth, top 10 dividend, and top 10 momentum stocks that are updated constantly, that's 40 high quality names, then click the link in the live chat or the first link in the description and become a member to get instant access to the top value, growth, dividend, and momentum stocks. And we don't just go to some screener. We have a precise methodology for how to pick these companies. And we actually give you an insight when we share the names with you on our process for picking the companies. And they are constantly updated. The momentum stocks list is updated once a week. The others are updated monthly, but often multiple times a month. In January, here it is the 12th, we've already updated all the lists twice. Maybe the dividend stock one only once so far. I'll have to double check on that. I think our pre-list before January or right around the beginning of January. Now I'm getting myself, it's a live stream, right? Bound to make a mistake or two during a live stream. But anywho, it's of great value. And I think you'd really love it. So definitely check that out. All right, I'll wrap the stream up here. Thank you guys so very much for joining me today. I greatly appreciate it. Hopefully, I provided enough value and kept you engaged and involved. And one of the biggest things that I hope was a takeaway today is that death cross, because it's coming up in Bitcoin. And I know a lot of people, and let me just pull Bitcoin up real quick. I know a lot of people are worried about that death cross, but for me, it's a lagging indicator. It just means that we've already been in a downtrend. And with several of the companies I've pointed out today, like Ally Financial, it doesn't mean a big downturn is coming. So just keep that in mind. Don't let the fear, uncertainty, and doubt creep in. And let me just go to Ally real quick, just as a reminder of what that death cross can look like. For Ally Financial, the death cross was right here on December 8th. Yes, it did go back down to the bottom of its support area here after that death cross, and then it rallied. So this is what a death cross can look like. And this leads you eventually, as the rally continues and as time moves on, to a golden cross, which is usually when you get to the peak of a rally, but still a lagging indicator. So thank you very much. I appreciate it. Awesome. All right, I'll wrap it up here. Thank you guys so very much for watching, and I'll see you in the next video.